Hello everyone, welcome back to my channel. And today we are going to have a discussion on the credit rating agencies, right? And before I even start on credit or credit rating, I would like you to sit with the title of this video, right? Because it actually sounds like a conspiracy thriller, right? The three companies that decide who the world trusts. And it's not the government, it's not even United Nations, and it's not even the country's central bank. It's actually three companies. And here's the thing, this line is not really a clickbait. That is almost word for word how the global finance actually works. Somewhere out there right now, a country is trying to borrow money to build hospitals. A company is trying to raise cash to expand a factory, and the interest rate, the literal cost of that money, is shaped by a letter grade handed out by one of those three private firms. So today we're going to pull back the curtain on Moody's, S&P Global, Fitch ratings, and not just what they do, but why they exist in the first place. How a guy borrowing 10,000 rupees from a friend is secretly in the same problem as United States borrowing trillions of dollars, and why one single letter, AAA versus triple B versus junk, can be worth hundreds of crore to a company per year. And by the end of this video, you are going to look at the news differently. You will hear S&P downgrade some company, and instead of scrolling past it, you are going to know exactly why that headline matters. So let's get into it. Right? A basic example, let's say we are talking about two companies, company A and company B, right? The fact about these two companies are they are in the same industries, they have the same operations, but there is one thing that is very different about them. The company A can borrow at 5% per annum, and company B can do the same amount at 12%. Why? What makes investors treat them so differently? What is happening in the background is actually, regardless of the companies being in the same industry and having exactly the same operation, investors trust this company. But investors are not pretty sure about company B. They believe that there is certain risk, and that risk needs to be awarded with some reward. So investors demand higher return when they are lending money to company B. But again, why and how? Right? So, what is happening is that somewhere in the background, someone is giving out instructions in forms of opinions, in form of investment grades. They are basically grading companies on what? AAA, triple B, calling them junk companies, right? But AAA. So first of all, what would be your best guess on a triple A investment bond? Triple A sounds good, high quality, right? Triple B sounds good, not as good as triple A, of course. Investment grade would be like a B plus or B minus in a report card. We can say that, right? And junk. I don't think any clarification is required at this point, but we surely know that high risk taking individuals are definitely gonna stick with the junk bonds. The risk is gonna be super high, and so as the reward, right? Speculators are gonna love it, right? So, what triple A, triple B, and the label of junk, which we'll study, it is a judgment that could actually change the future of the company. How? How? See, what if this company A is given triple A, right? It is paying 5%. What if this company B originally had triple B, and that's why it is paying 12%? What if tomorrow the ratings of company A changes to triple B? Don't you think the company A would also be liable to give the 12% interest? That is fair? Of course, this is going to happen. So, just because of an opinion of one of the three private companies changed regarding a particular company, they are now obligated to pay 7% more interest on the same amount borrowed. This changes everything. 7% is a absolutely big number, right? It could actually wipe out all the visible profits in the statements, right? So we have to go deep down on it no matter what, right? We have to understand how much influence do they actually have, and how are they able to destroy trillions of dollars of other companies. What do they actually do? See, they don't actually lend out money, they don't regulate the operations of the companies, and all they do is they issue opinions, right? But Moody's, S&P Global, Fitch ratings, their opinions are harsh, strong enough to move markets, set up borrowing costs, and shape the economies all together. Right? So let's first touch the ground, right? Why does credit risk even exist? See, think of a scenario where your friend is asking you a loan of 10,000 rupees. You think, see, it's a friend, so interest, stop thinking about interest rate for now, right? He's your friend, it's an informal contract. All you want from your friend is your capital back, don't you think? So the first question when a friend is asking money from you is, would he be giving me that money back? After 1 year, would I see the same amount of money back or not? That is the first question, not the interest payments, right? And that's basically trust. If you are able to make your mind that the repayment probability is 100%, you'll get the loan at full value, right? And if you think that okay, he will return some money but not all, right, but he will return something, let's say 50%, so your loan is now worth half. See, this was your friend. When you are in an environment in which you are entering just to invest and gain a profit, this is not something that you would be placing your bets on like that. It was your friend. In the real world, there are companies you never even heard of. Companies you have heard about maybe just a day ago, right? So, how do you build that trust, right? Where does confidence come from, right? So, when we're talking about finance, it's definitely a foundational thing would be credit risk, right? Foundational risk base for lending decisions, right? Can this borrower repay in future, right? Interest is the secondary thing. First you have to make sure that your capital is safe. Can this borrower repay, right? So every loan, every bond, every investment ultimately asks, will I get my money back and when, right? And that's why credit rating agencies exist to answer this particular question, but at scale, right? So what is actually happening? What if we try to understand the problem? What would it be? See, for that, let's travel back to the early 1900s in America, right? Because this is genuinely where our story begins, and it's less of a boring history lecture and more of, here's an actual crisis that needed solving. Picture being an investor in that era, 1900s. The American economy is exploding with railroads, maybe factories, industrial companies. All of them are hungry for capital to expand. Hundreds of companies are competing for your money, and you, the investors, physically cannot fly out and personally investigate every single one of them. You know about your friend, but you don't know about the company who is having operation 500 kilometers away from where you live. Right? There is not actually enough time for that. There was no internet. There is no way to verify these companies are whatever they are telling you, it is true or not. Now, this is the problem. The borrower is someone who knows everything. It knows about the true financial health, the hidden risk, and their future plans, and what are the actual cash flows. Only the borrower has the entire information. Right? When we're talking about the investors know very very little, because only the public information which is actually printed and made public is available. No other information about the company we know. Right? We don't have inside view. Right? Half the information cut down. We have limited time and thousands of options. Which one to choose? Right? And economists have precise term for this particular gap. This is called information asymmetry. One side has dramatically more information than the other, and here's the consequence that matters most. When investors can't tell a genuinely healthy company from a disguised disaster, they don't take the risk and just don't invest, which ultimately freezes capital and creates uncertainty. Right? So, just to solve this gap between these two stakeholders, there comes the credit rating agencies. Right? So, but they never existed from the first place. Right? The problem existed here, and what was the viable solution for that? Investors basically needed neutral third party. What they wanted from them is to run standard analysis of borrowers, and a same methodology should be used for each and every one of them, so that we can actually make sure the numbers make sense when we are having a comparison. Right? They should have specialized expertise, that is deep financial and industry knowledge. Now, why is this very important? See, I'll give you a very good example here. Right? So, okay, before starting that, I'll make sure one thing is very very clear. When I'm talking about deep financial knowledge, see, credit rating is very much different from uh, any financial term that is telling you about profitability. That is totally different. See, profitability is a measure that cannot be used for credit ratings. Right? What is actually used for credit rating is probabilities of default. What are the chances that this company is going to default? Right? So if we look with the profitability angle, what is happening for company A is they're having an EBIT of 100 crores. With company B, EBIT is 80 crores. So naturally, if we prefer profitability, company A would be a far superior choice than company B. Right? Because its EBIT is obviously more than company B. So company A should be a choice. But the problem comes in when we take into picture the whole scenario. See, company A is having a debt of 1000 crores and company B is having a debt of only 100 crores. Right? The difference in EBIT was 20 crores, but the difference in debt is 900 crores. This is a big difference. Let's say we calculate the interest coverage ratio of company A. What is interest coverage ratio? I've covered it in the zombie companies video. Right? What interest coverage ratio basically tells you, it's as simple as that. It is basically we have EBIT over interest payments. Right? Let's say your EBIT is 200. A different example. Let's say your EBIT is 200 and your interest is 100. So you basically have twice the operating profit than your interest payment obligations. Right? So this would be 2. But for company A, we can see it is 1.1. So it has barely more of operating profit that would be left after deducting the interest obligations. So imagine the amount of the minimum amount of profit that would be left at the end. Right? But when we are talking about company B, because there's a difference of 900 crores of debt, the interest coverage comes out to be 8x, which means that the company B is earning EBIT, the operating profit, 8 times more than the interest obligations. So this comes out to be a healthy. And see, the probability of defaulting, because much of the operating profit is being consumed in the debt obligations, so the probability of default in company A is a lot higher. But because it has 8 times the operating profit of the interest obligation, companies B probability of default is quite low, right? It is quite low. So profitability is not the variable you want to go when you are talking about credit risk, right? So company B may deserve the better rating despite lower profit. Ratings basically focuses on the repayment ability and not about the earnings, right? Now let's talk about these letters, right? So this is what all the ratings are, right? We have triple A, double A, triple B, double B, B, triple C, double C or C, and then we have the default. So basically what triple A is telling you is that the probability of default is 0.1%. There are 99.9% chance that the the borrower is gonna repay, right? And this basically what happens in this, the default probability is going to increase as we go down, right? Then ultimately it leads to the D rating, which probably tells that the company has already defaulted. If it's double C, the default probability is quite high, around 50%, and in triple C, the default probability is 70%, right? Default probability is 30%, I'm sorry, that the chances of getting your money back is 70%. And see what happens here is, because in AAA the default probability is quite less, so the return is less as well, right? And when the default probability rises, the return also rises, right? So when we are talking about bonds like triple C and double C or C, this is a totally gone situation, right? It has defaulted, right? So when we're talking about bonds with rating of triple C, bonds or any asset or any company or any country as well. I'm sorry, I'm limiting it to bonds. I'm really sorry for that. But these ratings could be for a country as well. Not even for a company's bond, but for a bond, for a company's, and even the country as well. Right? So when we're talking about triple C and double C or C, basically what we are going to experience is higher yield as compared to triple A, right? So what is happening here is double A or triple A, double A, and triple B are considered as relatively safe, right? For these companies, countries, bonds, the borrowing cost is quite less. That is, if you are buying a buying a bond, the yield is going to be less, right? Pension funds and insurance are basically okay with buying these or investing in these kind of companies or countries, right? And regulators treat as lower risk, right? When we're talking about double B, C, triple C, double C, C, and D, the risk of default is quite high. So because the risk is high, the interest demanded would obviously be very high. And when it comes to this particular thing, right, this basically entire, so starting from till this it is good, below this all of these are called junk, right? They're called junk bonds. Starting from double B to C, their rewards are high, risk are high, and high potential returns for risk tolerant investors. So rather than pension funds and insurance companies, you would see risk taking investors investing in these types of companies, right? Now, see what is the problem. I've also earlier talked about it with the company A and company B example. Just because the company's investment grade is AAA, companies, countries, again, bonds. I'm really sorry, I'm just not using the perfect terminology for that here. But let's say the company, right? We are taking company's example. They want to borrow 10,000 crore rupees, but the investment grades of that particular company is AAA, right? So they can easily get the loan for 5% interest. But because of the any reason, see, any reason, be it macro, micro, political, geopolitics, systematic risk, unsystematic risk, whatever it is, let's say the ratings drop to, let's say, double B. So eventually the borrowing cost would increase, right? Just because the opinion by one of the three private companies changed about a particular company, the same company I'm talking about, the same company. Once it was rated AAA, but now it's rated triple double B, right? So it would directly impact the interest obligation, which now became 1000 crores from 500 crores. So you need extra 500 crores every year, right? So lower rating is actually impacting your bottom line, right? So a single downward can cost hundreds of crores annually and basically wipe out your profits on one side and also change your corporate strategy forever, right? See, why are investors basically trusting them, right? You have to make sure that you understand one thing very clearly. We were talking about America in 1900s when we talked about we have less information available, right? The things have changed, but even today it's not possible that we go through each and every statement, con calls, quarterly reports, balance sheet, cash flow statements, income statements, peer comparison, DCF valuation, comparative valuation of each and every company, right? It is very, very difficult today as well, right? But what and how can credit rating agencies help us? They are basically providing us with the first step. We want to, we see, we all have our investing philosophy. We are either risk takers or we are loss averters, right? So what we can do, if we are risk takers, we can use the credit rating agencies grading system and target double B, single B, triple C, double C, or any bonds like this, right? Because we want high yield, we are in the game for money, right? So it can act as a first screening mechanism, right? But it is very important that you don't actually consider these ratings as the final decision. It is just the first step, right? Because ratings are opinions and ratings are already and totally based on all the information that the particular company which is rated provides to the rating agents, right? Only and only whatever information rating agencies get from the company whom they are rating, based on that they develop an opinion and give out ratings. So there is no guarantees, right? There is no guarantee. There are one data point among many: financial systems, management quality, industry trends, macroeconomic conditions. You have to make your decisions based on these things as well. This for individual investors could be a first step and not and nothing more than that. Right? So we've talked a lot about rating agencies. Now let's take a look at some of the examples. See what happened with Enron. What Enron was doing was it actually appeared to be quite healthy on the surface. And how did it do that? So basically, they created off balance sheet entities, or you can say shell companies, right? And with the help of these shell companies, they hid massive debts. Now, rating agencies were not able to have a control and opinion about these shell companies. Everything looked very healthy in Enron balance sheet, and it survived with a triple A investment grade until it was completely destroyed. Completely destroyed. The rating agencies can only evaluate what it can observe. Ratings totally depend on all the available information, only and only available information, and the willingness of the companies to disclose the truth. Enron was not willing to disclose the truth, right? Ratings are not omniscient, they are limited by transparency, right? This is very important for you to understand. Now, can a country be downgraded? We have talked about bonds, we have talked about companies taking loans. Can a country be downgraded? I'll give you an example. In 2011, United States went from AAA to AA plus, a country who maintained AAA ratings for decades in past. In 2011, S&P downgraded United States. It actually made global headlines, market reacted, and it proved that even world's largest economy is not immune to rating judgments. Right? See, the deeper point here to understand is country borrow money just like corporations. So it is very important to make sure that we give credit ratings to them as well. Governments actually needs trust too. If you are giving someone loan, you have to make sure that the company is physically disciplined, they have political stability, they have debt sustainability, and they have to factor into foreign ratings, sovereign ratings, right? So it is not just for the bonds or maybe a company. It is very important decision, right? If you're not focusing on the fiscal discipline, political stability, debt sustainability, we might not even get our money back, right? The real skin in the game is actually the principal. Interest is a very small amount as compared to the uh, principal. Interest is a very small amount, so we, our first goal, our first priority is to make sure that our capital is secure, right? Which is very, very, very important. So now, there is a very big conflict as well. See, when we're talking about rating agencies, what actually happens is, in the first place, the company who has to borrow funds actually goes to the rating agencies. They actually pay them fees. Listen to me. They actually pay them fees for the rating agencies to rate the companies. And then the rating agencies issue ratings. Now, I know it is a very comfortable question, but yes, doesn't this create a conflict of interest? The entity being rated is paying the rater, right? And it is actually called issuer pays model. And to be honest, the structure is quite dominant in the industry, right? And talking about finance, it's ultimately a study of incentives, right? So this model has obviously been in debate for decades, but it is a very dominant structure in the industry, if I talk about, right? So the conflict usually says that, see, if we actually understand what supporters have to say about it, see, whatever people personnel are sitting in Moody's, S&P, they actually have expertise. See, they're not some random people who are just, you know, doesn't know what they are doing, right? Plus, agencies, they are such a big names, right? Agencies actually have their skin in game. They don't, lend money or do anything, but if there are three private companies, they have to be credible, right? Whatever rating, see, if I'll be really honest with you, if they are labeling C grade companies at maybe triple A or let's say double A, right? The chances of default are still there. They are just giving out fake ratings, right? If this keeps on happening, they will eventually lose their credibility and their reputation. So they have a reputation to maintain as well, right? So again, post 2008, in which, see, in 2008 crisis, the agencies rated toxic assets at AAA. It has already happened. It's not something new or up for a debate right now or today, but it's been in these kind of things, right? So all we need to do is to increase the transparency, right? See what actually is happening. See, if the company has to pay fees and the rating agencies are giving out ratings, see, we have three companies. Why would we pay a company which is giving us a lower rating? So that's why critics argue that it basically tends to be shopping for a better rating, right? And of course, there is a pressure to maintain a issuer relationship, right? So there is a systematic risk that always goes around that. But again, these companies also have a reputation to maintain, right? So there are somewhat credibility that still exists in the system, right? The truth is nuanced. The model has flaws, but it also enables the scale of modern capital markets, right? It is such a big market now. We have to have a support of the first step at least, right? So the reforms continue, but incentives matter deeply. So when we're talking about in micro level, that is our friends, that we take took an example of a friend, right? The question that we ask is, can he pay back my loan? Yes or no? When we're talking about company, see, when we're talking about companies, there comes in the interest rate. So whatever the interest rate is, depending on the ratings or anything else, can we actually afford that interest rate? Is our range between 5 to 10% and we can only get it at 12%, right? This is the decision that we are talking about. When we're talking about the entire economy, see, what is happening is, how is risk priced across markets? See, the ratings are actually quantifying risk for you in terms of yield, the interest rates. We are able to quantify risk. That's the biggest thing, right? Through a grading system, right? So how do they basically decide who gets to borrow? So basically what they do is, they go through the financial statement, they go through the cash flows, they understand the debt levels. So financial statements basically shows the structure, cash flows tells you the reality of the actual cash, and debt levels basically combined gives a powerful number that can actually help them estimate the default probability. And based on the default probability, we give out ratings like AAA to D. Then we have to make sure, after the credit ratings, right, we have to make sure that the business had its own risk and economic conditions which are not following any pattern are there to turn the tables as well, right? So at the core of the modern finance, investors on one side, borrowers are on the other side, and they rarely know each other directly, right? So what rating agencies basically do is, they become the bridge to that gap with uninformed opinions. See, credit rating agencies don't decide who is good or bad, right? Whatever they are trying to do is, they are trying to give you an estimate that are they compatible enough to repay their debts or not, right? That's only an opinion, and that can change the cost of capital for the entire companies as well as countries. See, countries also have to focus about the cost of borrowing, right? So this is a very very important line that you must understand, which is, modern finance runs on credit and credit runs on trust, right? The three rating agencies sit at the center of that trust equation, not as gods but as influential interpreters of the financial reality, right? Credit ratings don't actually predict the future, they are basically pricing the uncertainty. In a world where trillions of dollars move based on trust, because modern finance runs on credit and credit runs on trust, those opinions become extraordinarily powerful, right? And that's the story of the three companies which are quietly sitting behind trillions of dollars in global capital. If there is one thing I hope sticks with you, it's that the financial system is full of these hidden institutions. Things you scroll past in the news without even a second thought. And that genuinely determine who gets funded, who gets to grow, and who actually survives. If this video helped to click into that place for you, do me a favor and hit like. It genuinely helps the channel reach more people who are also curious about the finance and how it actually works behind the headlines. Share it with that friend who always asks you confusing finance question. This one is definitely for them. And I genuinely would love to hear from you in the comments. What do you think about the issuer pays model? Is it a necessary evil that keeps capital markets running, or is it just a structural flaw that needs a little bit fixing? Drop your take below. I read this, and some of the best conversation on this channel happens right there in the comment section. Thank you so much for watching all the way through. I'll see you in the next one.